Welcome to the second study session of fixed income. Here we've got two readings. The first reading is on trading the yield curve or yield curve strategies. The second reading is on credit strategies. Now in this first reading here, we are looking at the risk-free yield curve, the benchmark yield curve. Okay, so there's no credit risk here. We're just thinking, what is our view on what this curve is going to do over our investment horizon? And how can we profit from that view? This reading is all about active management of our portfolio to take advantage, in other words, to profit from our expectations as to what this yield curve will do over our trade horizon, over the next 6 months, for example, if we're investing for 6 months, or the next year. The case will guide you on the time horizon. Notice that we could expect the yield curve to change over the investment horizon. In this particular module, we're just going to think about what we can do to outperform if we expect the yield curve to remain stable over time. That's what we're going to do in module 1. Later modules, we're going to think about what we should do if we expect a change in level of the yield curve, that's a parallel shift up and down, or a change in slope, becoming flatter or steeper, or a change in curvature, measured via the butterfly spread, as we've seen before. If you're approaching fixed income in the order that it appears in the curriculum, then you have actually met all of these points before in terms of how the yield curve could shift. We discussed it when we were doing LDI earlier. So we're not seeing brand new stuff here. Really, we should reinforce our definitions of what these shape changes mean and then think about how we position a bond portfolio to profit from these changes should they come to pass. Now, forecasting that the yield curve remains stable over time, that's what we're going to focus on in this module, and it's important to realize that this is an active view. Okay? It's also important to realize what it means by the yield curve staying stable over time. So here is a yield curve. A yield curve is a plot of yields versus maturities, and I'm not going to write those axes again. I'm going to assume you know what I mean when I talk about a yield curve. So there's a yield curve with yields rising as we look at longer dated instruments. Now, just to really make sure we've got our foundations in place. A yield curve staying stable over time means that we look at the yield curve today, at T0, for example, and we see these yields going out for different maturities. We put a trade on, and we know when we come back and look at the yield curve, say in 6 months or in a year's time, in other words, at the end of our investment horizon, we see the same yield curve. That's what we mean by the yield curve remaining stable. If we buy a bond with, say, 5 years to go to maturity, and we hold it for a year, it's only got 4 years to go to maturity, and we know that if the yield curve hasn't changed, its yield will move from here, 5 years to go at initiation today, and in a year's time, it'll only have 4 years to go, its yield will move to there. Okay, that's exactly the same concept as we were talking about in the first fixed income reading when we were talking about roll down return. We assumed the yield curve remained stable, and we essentially knew therefore what our starting yield and prices and our ending yield and prices are going to be, and that was referred to as the roll down return. So it's exactly the same idea as that. How can we maximize our return if we have the active view that the yield curve remains stable over time? It's important to appreciate that the yield curve staying stable over time is an active view. What do I mean by that? I mean it's your forecast. It might not agree with what everybody else thinks in the market. You can earn excess returns from taking that view and expressing that view through your portfolio and outperforming the general market. Now, like we've been doing in the LDI reading when we're talking about structural risk, we're going to focus on taking positions in our portfolio at the short term, medium term, and long term maturities. So short is over here, medium term is here, and long term is over here. I might refer to these as short dated cash flows, medium dated cash flows, and long dated cash flows. I always try to throw the word dated in when I'm talking about when the cash flows occur, so we don't confuse long and short with the position that we are taking. That's not going to help at all. But the general idea is that we can choose how to distribute our cash flows across these maturities in order to outperform a fixed income benchmark given our yield curve view. Right, so let's reinforce these changes in the yield curve. Make sure we know what these changes in the yield curve are. So parallel shift, we should be comfortable with that. It's duration that measures your sensitivity to a parallel shift in rates. All yields shift up or down by the same amount. That's the risk factor, if you like. That's the change that duration measures your sensitivity to. So there's an upward parallel shift. The key point here is the shape of the curve hasn't changed. There's a downward parallel shift, which I could have drawn a little bit better. That should, of course, not change shape there. All right. A steepening is where long-term rates rise by more than short-term rates or yields. Now, you've got here a steepening. I would actually argue that this is a shift up and steepening. If we started with this bold line here, steepening would just be long rates going up and short rates going down. That would be a steepening without any shift in rates. It looks to me like there's a steepening here, long rates going up, short rates going down, and then that curve shifts up as well. So there's general rising rate level as well there. We'll talk a bit in later modules about how you express your view that rates are going to, the yield curve is going to steepen and generally rates are going to rise. But a steepener, as the name suggests, the yield curve becomes more steep. Flattener, as the name suggests, or a flattening curve, the yield curve is going to get less steep. So it's going to move from the bold line there to the dotted line. So short-term rates are rising, long-term rates are falling. Very visual, these descriptions, I think, so far. Where you have to tread a little bit carefully with regards to yield curve changes is a change in curvature. So the yield curve, we assume, is concave. That's the natural shape for it. Concave is a frown, all right, like the opposite of a smile. A convexity is a smiley thing. We talk about the price versus yield relationship of a bond as being convex, and it's smiley, happy. The opposite of convexity is being concave or concavity. And the yield curve, that's a plot of yields versus maturities, that is concave. It's like the top of a ball instead of the underside of a ball. Okay, it's sad. It's generally a bit of a frown. Now, that's the curvature. The curvature is essentially the how concave this yield curve is. And a change in that curvature means we're either becoming more curved, okay, like is happening in the graphic here, that's an increase in curvature, or less curved. Less curved would mean we become more of a straight line. So this is a decrease in curvature. All right, that's curvature falling, where we're becoming more of a straight line. Now, generally, the curvature increases if intermediate medium-term rates rise by more than short-term and long-term rates. You can see that there. That's an increase in curvature. Over here, in that particular graphic, over here we've got decreasing curvature. Can you see that yields in the middle have fallen by more than yields at the extremities? So the yields at the extremities have stayed the same, but yields in the middle have fallen. So that's a decrease in curvature when intermediate rates fall by more than the short and long-term rates. In terms of language and jargon here, this increased curvature makes you more unhappy. Okay, it's referred to, it increases your frown, and that's how I remember it's referred to as a negative butterfly shift in the curve, a negative butterfly. Okay, when the curvature falls, actually you become less frowned. In fact, you can argue you're starting to cheer up a bit and starting to smile a bit. Not that the yield curve will go convex, but you're frowning less. Curvature falling means you're frowning less, and that means that the memory trick there is that you're becoming more positive. All right, so it's a positive butterfly shift. All right, if you frown less, if your curvature falls. So increased curvature means you are frowning more, and people that frown more are negative. It's just a visual thing. All right, a falling curvature means you're frowning less, and people that frown less and smile more tend to be positive people. The other way of measuring, actually calculating what your butterfly spread is. It's referred to as a butterfly spread, by the way, because when we've got 3 rates or 3 maturities, we see it in options when we've got 3 strikes in play. We often talk about the wings, all right, the long and the short doing the same thing, and the body in the middle maybe doing something else. All right, so, and that's kind of why we call it a butterfly, because a butterfly's got a body and 2 wings, hasn't it? So the butterfly spread is a calculation we can do to measure curvature. It's 2 times the medium-term yield minus the sum of the wings, essentially. 2 times the body, in terms of rates, minus the wings. Now, I want you to think about what the butterfly spread will do in this case where we have increased curvature. Intermediate rates are going up. If you think about the butterfly spread, it's 2 lots of the body minus the wings. What have we got here? We've got intermediate rates, the body, that's going up, and more, in this particular case, that's outperforming the wings. They're not doing so well, all right? So what's going to happen to this butterfly spread? This butterfly spread's going to go up, okay? So just be careful with this, because the body's going up by more than the wings. Just be careful. Once again, visually you can see that. Take care with the language here. Increased curvature, increased butterfly spread. Yeah, we like that, but that's associated with a negative butterfly shift. So be careful with that. The butterfly spread goes up when we have a negative butterfly shift. That's more curvature when we have a negative butterfly shift. We frown more. Similarly over here, if you think about what the butterfly spread's doing over here, 2 lots of the body minus the wings, some of the wings. What have we got? The body's falling by more than the wings, so the butterfly spread's going to be falling overall. Now just be careful. Yes, that ties in with a fall in curvature, a fall in the butterfly spread. That's nice and intuitive. However, that is associated with a positive butterfly shift. Okay? In other words, we're frowning less. Okay, now this slide is straight out of a previous reading when we're talking about immunisation. We're really just looking at the types of bond portfolio that are available to us. With immunisation, we were looking at immunising a liability. Here in active management, we're thinking about what bond portfolios are available to us when we're trying to exploit our view of the yield curve. So we have seen these before as well. You've got a bullet portfolio. If you've got similar duration portfolios, you could have, with regards to dispersion of your cash flows, you could have very low dispersion of cash flows. All right, with a bullet portfolio where cash flows occur around about the same time, around about their duration. Or you could have a ladder where the cash flows of your portfolio are relatively evenly dispersed across maturities. On average, they're the same as the bullet, but they're evenly spread. So that's kind of like medium dispersion of cash flows. The highest dispersion of cash flows you can have is a barbell, where all of your cash flows are either in the short end or the long end of the curve. You've still got the same average time, average overall duration, but your cash flows are clustered in the ends of the curve, essentially the short end and the long end. So these are very visual as well, aren't they? They've got a bullet in one shot, ladder with its rungs, and the barbell, which you can almost see the weightlifter picking it up. Okay. In terms of, that's a weightlifter's hands there if you're wondering what I'm doing. All right, I won't go on with that. So when we think about the important points about these different portfolios, remember that convexity and dispersion, if you've got the same duration and same returns, convexity and dispersion are essentially they're directly related, and convexity will be driven by dispersion if you've got the same duration and the same overall return in your portfolio. There was a little formula we looked at a couple of times in the last study session, which linked convexity to duration squared, duration, and dispersion, and yields. Now, if yields and duration are the same, the only thing that's different that's driving convexity, differences in convexity, is differences in dispersion of cash flows over time. So we can say that the convexity of the bullet will be lowest, the convexity of the barbell will be highest, and the ladder will be somewhere in between. With a concave yield curve, you would expect the yield of the bullet to be highest. Okay, with a concave yield curve, a bullet with cash flows here is like to have a higher yield than a barbell with cash flows that are distributed down here and up here. Due to the concave nature, we're not getting as much yield pickup on these cash flows as we are losing in yield on these cash flows, essentially. In terms of, so they'd like to be lower yield down here, but from a convexity perspective, we've already said highest convexity with the barbell, lowest convexity with the bullet. So you're making up yield here with the bullet, but you're likely to have low convexity. All right. You're not getting as much yield down here with the barbell, but you're likely to be getting more convexity. The ladder was introduced in the immunization section as having the advantages of generating natural periodic liquidity if you need it, and being diversified across yield curve maturities, and therefore being diversified with respect to price risk on later cash flows, whose value will fall if rates go up, and reinvestment risk on early cash flows, where we don't get as much reinvestment if rates go down. We're balancing those out. Actually, rather than removing them, we're balancing those out through the even distribution of our cash flows over time. Okay, let's have a quick look at an example of how a bullet and a barbell would perform under a parallel shift of the yield curve. It might be worth thinking, before we just jump in and smash calculator keys, it might be worth thinking what we expect here. There's 3 bonds with different maturities. Obviously the bullet's going to be shooting at the middle one and putting all of its weight in the middle one. The barbell is going to be distributed between the short one and the long one. There's the barbell there. You're given the weights of the barbell, and they look quite specific: 46.68, 53.32. I would wager that those weights make your barbell in the 2 and 20 years have the same overall duration as the bullet in the 10-year. And we'll go with modified duration here because that's the useful measure, telling us our actual sensitivity to a unit change in rates. So I would wager that when you put 0.4668 or 46.68% in the 2-year bond with a duration of 1.86, and then you put 53.32% in the 20-year bond with duration of 16.23, I'd wager when you calculate your cash weighted duration there, it comes out as the same duration as the bullet, which is all in the 10-year. And that's exactly what happens. We get 9.52, and that's the same overall duration as the bullet. So the idea is we're making these portfolios the same from a duration perspective, and then we're thinking about how they're likely to perform given a parallel shift in the yield curve. Now, let's think. If durations are the same, we'd expect from a duration perspective a parallel shift to lead to the same changes in price. Yeah. However, what's going to be the difference between these two portfolios? There's going to be a small difference. And what is that? It's convexity. The barbell is going to be more convex than the bullet. And convexity is always a positive, isn't it? Just to reinforce something we've seen many times, but it's good to revise and reinforce concepts. The price versus yield relationship for an individual bond. When yields are low, prices are high. When yields are high, prices are low. But it's not a straight line. It is actually a convex line, like this, smiley line. Okay, convexity makes you happy, remember. And convexity does make you happy because duration, of course, is based on the first derivative, the rate of change of price versus yield. That's what duration is based on. So if we're standing here at the start with this price and this yield, duration is based on this straight line, the tangent of this line. And convexity, the convexity adjustment says, well, and the actual relationship, the blue line, is slightly convex or very convex, depending on the bond that you're looking at. And convexity always makes you happy. That's why I describe convexity as smiley. The convexity adjustment is always a positive. The convexity adjustment means that you go up more than duration suggests, the red line when yields fall, and you go down less when yields rise, down less than duration would suggest. And higher convexity, if I bring in a higher convexity bond here, it's more smiley. All right, this orange line is, let's try that again. This orange line is a higher convex bond. All right, forgive me for the wobbly nature of the line, but that's a higher convexity bond. And, you know, that's always better off than the blue line, which has got lower convexity. Yeah. So high convexity is a good thing when we're thinking about shifts in yield. This kind of delta y to the left, right, sorry, delta y to the left. You know, high convexity is a good thing when we're thinking about shifts in yields alone and their impact on price. So given that the barbell is high convexity here, we are going to find that the barbell is going to outperform. Let's do the calculations. Here is our old friend, the duration and convexity formula. This is how we calculate the impact in percent terms on values or prices from some assumed shift in yield. By the way, the shift in yield here is 50 basis points. That's a parallel shift. So there's your delta y, 50 basis points. And we know that the straight line, the duration estimate for changes in prices, you can just scale up the change in yield, then multiply through by the negative of duration to think about that linear relationship between price and yield. And here comes the convexity adjustment, which is always positive, and it's 1/2 of the convexity of the bond times times change in yield squared. Now, convexity is a second order measure. In other words, it's looking at the rate of change of the rate of change. You know, there's a gradient here, and the gradient changes. It's the rate of change of that gradient. So being second order, the rate of change of the rate of change, it's good enough for us to just think with convexity you've got lots of 2's, or a couple of 2's you need to consider. So you need to scale convexity down by 1/2, and you need to essentially multiply through by change in yield squared. If you can associate that with it being a second order estimation, then you're where you need to be. You need to use it rather than mathematically explain why we do that. So let's have a look and see what we think the bullet portfolio is going to do. We expect a change in price of, it's got a modified duration of 952, and there's your delta y in decimal terms. Don't forget it's 50 basis points, which is 0.5%, but then we've got to divide by 100 to get it to decimalize it. So that's what that is, and then we're going to add 1/2 of the convexity of the intermediate bond, which was 104.8, okay, multiplied by 0.005 squared. So these numbers are just coming from the table here, all right, we're lifting them straight out the table. There's no mystery as to where they're coming from. We use them in this equation we've used many, many times before, and we see, unsurprisingly, that if we think rates are going to shift up, overall we're going to lose money on our bond. Let's have a look at portfolio 2, the barbell. So attack each individual bond individually and then weight the bonds according to their weights in the portfolio. So here, the percentage change in the 2-year bond, that's its modified duration of the 2-year bond. You can see these in the original table. I'm not going to keep flicking back there. There's your delta y. All right, make sure you make that negative because rates going up is a bad thing. It's the inverse price-yield relationship, that negative sign essentially. Plus 1/2 of the convexity of the short-dated bond multiplied by delta y squared. So that comes out at negative 0.92%. And then in the long-dated bond, similar process, negative modified duration was 16.23 times the delta y plus 1/2 of the convexity multiplied by delta y squared. Not surprised to see big convexities when we go out with this delta y. When we go out with this long-dated bond, we're not surprised to see big convexities there. Convexities can get quite big, but they do get scaled down very aggressively by this delta y squared in decimal terms. This comes out at minus 7.75. Not a surprise to see longer-dated bonds responding more to shifts in yield because of their higher duration. Now, you might remember that the weight of the short-dated bond in our portfolio 2, the barbell, the weight of the 2-year bond was 46.68%. We can multiply that by the minus 0.92. and the weight of the 20-year bond was 53.32%, we can multiply that by the negative 7.75, and we come out at minus 4.56. Now the barbell, that's what the barbell's doing. I'll just remind you the bullet underperformed, so there we see the impact of convexity. The barbell has outperformed, it's gone down by less, all right, 4.56 negative versus 4.63 negative. It's gone down less, okay, due to its higher convexity. Note that, as we said at the outset, both bonds have the same duration, so it's not the duration impact that is causing these bonds to behave differently, it is the convexity impact. Okay, so that was a demonstration that under a parallel yield curve shift, more convex bonds outperform. But the main focus of this reading from here on in is going to be the strategies that we should recommend or employ when we expect the yield curve to stay the same. Now, we mentioned earlier it's important that you appreciate that's an active view, and what it means is we look at the yield curve today and we see this, and when we come to take our trade off in 6 months or a year's time, we see this again, exactly the same yield curve. And we know that if we buy a bond with this yield today, when we come to take it off after this time has passed, we'll have rolled down the yield curve to here. All right, so we know exactly where we're going to be from a yield and therefore price perspective. So the sorts of things that we can do when we have the expectation that the yield curve's not going to change, really here we're looking at extending the duration of the bond portfolio beyond our investment horizon. The reason for that is assuming we have an upward sloping yield curve, which is always the default assumption. If we extend duration in our bonds, we add yield because we get higher yields at higher maturities and higher durations, and we can just buy those higher yielding bonds. We haven't got the risk, because of course extending duration is a risky strategy from an interest rate perspective. The risk is that rates shift up, but we don't expect any shift in yield because our yield curve is static. It's not going to shift up or down. So we extend our duration, we get a higher yield to compensate us for more interest rate risk, for more duration, and yet that risk doesn't crystallize. The yield curve doesn't shift up. We don't lose money, so we just collect that higher yield. Now this buy and hold strategy is low turnover, but essentially, to simplify and summarize, you're just extending your duration with the view that yields aren't going to shift up. So you increase your return, and when yields don't shift up, you outperform. In fact, you extend your duration and you buy and hold the security until the end of your time horizon and then sell it. You know that actually if an upward sloping yield curve is not going to change, you're going to sell your bonds on a lower yield because you roll down the yield curve over time, and there's likely to be a roll down return from a higher price at the end. Now that's a low turnover strategy because you just, as the name suggests, buy and hold one long dated bond for your whole investment horizon. A little bit more active from a trading perspective. These are all active strategies from a yield curve view perspective, by the way. The view that the yield curve stays static is an active view. But a little bit more active from a trading strategy is to ride the yield curve. So what we're going to do here is buy high yielding bonds, and then as they drop as time passes, we sell them and reinvest in high yielding bonds again. So you might look at this and say, well, hang on a minute, what's the difference between just buying and holding and riding the yield curve? Well, the difference is with riding the yield curve is we're trying to identify steep parts of the yield curve. So we might have a yield curve that looks like, something like this, right? Instead of us just buying and holding this bond here for a year, it's got a high yield. What we might do is buy this bond here and hold that for 6 months. So ride that steep part of the curve and then do it again. Sell this bond here at this lower yield once yields have fallen. This might give us better profits if we trade this. This might be 6 months here between this date and this date. Buy this bond, let its yield fall. You know the yield curve's not going to change, so let the yield fall. Sell it at a higher price. Then buy the longer dated bond again and wait 6 months for the yield to fall and sell it again. So you're trading a steep part of the yield curve. That's really what you're doing here, rather than just buying long dated securities and holding them for higher yield. Okay. Another trade for a static yield curve is to gear into your portfolio. Maybe do a repo. Repo, as we've seen before, is a sale and repurchase agreement. It's essentially a collateralized borrowing. You're borrowing, buying bonds and using the bonds as collateral for the loan. The carry trade, of course, is borrowing at low rates and depositing at high rates. So you'll be borrowing at the short end of the curve where rates are low and investing or depositing at the longer end of the curve where rates are high. Really here you're just gearing into a longer duration portfolio. And the risk, of course, is that yields shift up and your assets fall by more than your liabilities and you suffer. But of course, you don't think the yield curve is going to shift. You don't think it's going to shift at all. You're just going to essentially roll through time, collect the higher yield on your assets, and pay the lower return on your borrowing, and that's a straightforward carry trade over time. So really what we're doing here is extending duration either through changing our assets, trading our assets, or we're gearing into our portfolio. Of course, you can increase duration by using the implicit leverage of derivatives. Okay, remember that to increase duration through derivatives, you would buy Treasury bond futures contracts or you'd receive fixed under a swap. Once again, we mentioned this a lot earlier, but we'll just reinforce this. Duration is carried by the fixed leg of a swap. Okay, we met duration when we got into fixed income. If you have a fixed income, you've got positive duration. It means if rates go down, you win because you've got a fixed income. So when you're thinking about increasing your duration through a swap, which is really using the implicit leverage of a swap, you're going to receive fixed, you're going to get a fixed income, okay? So that's really just using derivatives to increase duration through the implicit leverage of the derivatives themselves. Now, if we're targeting a certain BPV in our portfolio to increase our duration, then we can take the targeted change in our BPV, divide through by the BPV, the basis point value of one futures contract, and then round to the nearest whole number of contracts to work out how many contracts we should go long. We're thinking here about futures, of course. This is a calculation we did do in the LDI section. Okay, so if you want to refresh that, go back and look at the liability-driven investing section in the previous reading. Just a reminder here, we did discuss it at length there, just a reminder that the BPV of the futures contract is related to the BPV of the underlying cheapest to deliver bond by dividing the BPV of the cheapest to deliver bond through by the conversion factor of the cheapest to deliver bond. We discussed that in the liability-driven reading. The conversion factor maps the deliverable cheapest to deliver bond to the notional bond quoted in the futures contract, which doesn't actually exist. That's a key relationship. It's the second time we've seen it. You should be able to use that little relationship should you need to. Okay, so let's finish this module with an example, a numerical example of what happens when we extend duration on either using longer duration bonds or by receiving fixed in a swap contract. Of course, this is an example of what we would do when we expected a static yield curve. We're extending duration to really collect a higher yield for interest rate risk when we don't expect interest rate risk to crystallize. We don't expect rates to go up. So you've got an active manager here. They have the view the yield curve will remain static over the next 6 months. That's their time horizon. Consider two trades, A and B. Trade A, unsurprisingly, is to buy a long duration bond, 10-year, 3%. They've only got a trade horizon of 6 months, but they buy a 10-year treasury with those details there. Trade B is to enter a receive fixed swap with a fixed rate at 3%. That's the swap fixed rate. And a floating rate currently at 0.5%. That's the market reference rate, the floating rate. 6 month horizon, we knew that. 50 million par value, okay, that sets the size of our position. And assume that we do get a 25 basis point fall in treasury yields and swap rates, which is against our view. We're going to do well here because we're extending duration and yields have fallen, but that wasn't actually our view that yields would shift down. So this is where we're going to draw upon some groundwork that we did before. In the first reading in fixed income, we had the total return decomposition calculation for a bond. There were 5 stages to that return decomposition. Number 1 was coupon income, which was just coupon divided by price. Number 2 was roll down return, which is essentially our due to our change in price under a static yield curve. So really that return is what we're playing here. If we're assuming that the yield curve is going to be static, that's the return that we're playing. Do you remember that part 3 was the impact, the duration and convexity impact of a change in benchmark yields? I should say benchmark rates here flowing through into yields. Number 4 was the impact of changes in spreads flowing through into bond yields. And part 5 was the impact of foreign exchange. Now, we're just going to look at, this question is going to ask us about these 3 here, really. We're breaking out how our trade did due to coupon income, roll down return, that's just the passage of time under a static yield curve, and the impact of any change in rates flowing through into yields. And Treasury yields and swap rates have both fallen by 25 basis points here. So we didn't forecast that, but we'll think about the impact of that on our trade. We know it's going to have a positive impact because we're extending duration here with our view that the yield curve is going to stay static. Okay, so let's consider the coupon income and the price appreciation for trade A. We're going to break the price appreciation down into roll down, that's part 2 of the return decomposition, and the change in price due to changes in rates, that's part 3 of the return decomposition. Coupon income is part 1. So this is revision. It's good revision of the total return decomposition we saw 2 readings ago, the first reading in fixed income. We asked here to calculate the swap carry for 6 months. Carry, of course, is the income on the fixed leg, what you're receiving in, over what you're paying out, and any mark-to-mark gain or loss on the swap due to changes in swap rates. Okay, so we'll have a look at that as well. Don't forget, time passes. We're going to have a time difference of 6 months between now and when we come to mark-to-market at the end of our trade horizon. Okay, so part 1 here, calculate the coupon income from buying the Treasury bond, trade A. Okay, you might remember, or not, that the bond had a 3% semi-annual coupon. So that's really 1.5% per 6 months. And if we take that 1.5% of our par amount of 50 million, we'll get in sterling terms our coupon income. So that's what's happening here. Take your par amount, multiply by the annual coupon, divide by 2 because it's actually a semi-annual coupon. And we're looking at 1 6-month period. Okay, we will collect £750,000 worth of coupon here. We're going to work in $100 a par when we think about price, which can scale up to 50 million par later on, but let's, if you like, standardise to £100 of par because prices are quoted for £100 of par. Now, the price of the bond now, if we flick back a little bit, the price of the bond now is 104.3998. All right, that's the price of the bond now with 10 years to go. In terms of what we expect in 6 months' time, we need to think that in 6 months' time we're going to reprice the bond. It's only going to have 9.5 years left. With 6 months gone, it's got 9.5 years left, which is 19 semi-annual periods. Okay, so using the TVM of our Texas calculator, probably best to clear your TVM to begin with. So second FV clears the TVM. Then if you hit 19N, you'll populate the number of periods field. Remember, we're thinking about the price of the bond in 6 months. The payment, the 6 monthly coupon of 1.5% of a par amount of 100. This hasn't changed, so 1.5 PMT, 100 FV for £100 worth of par. All right, that represents the par amount back at the end. The thing that has changed is the yield of the bond. Now, we're told that yields fall by 25 basis points. The Treasury started off yielding 2.5. If it falls by 25 basis points, it's going to be yielding 2.25%. And don't forget that we need to consider the semi-annual yield of the bond. So take that 2.25, that's the new yield of the bond. original yield of 2.5% minus the 0.25 delta y. Okay, that's the annual yield. You need to divide that by 2 to get to the true periodic semi-annual rate of return of the bond. So that's where we get this 1.125 from. So there you go, 19 semi-annual periods left, 1.125 periodic yield, 1.5 periodic income, and 100 par. You can compute PV there to get 106.3828. That's the actual price of the bond in 6 months' time. So time has passed and yields have shifted. So all of your return is baked into this price, essentially, plus that coupon up there for your 6 month period, if we ignore any other factors. Now, here's a crucial calculation. If we price the bond in 6 months' time and we don't include the shift in treasury yields, so essentially we're going to do exactly the same analysis here, but we're not going to shift yields down by 25 basis points. We're going to leave yields as they are. All right, so we're going to assume, there's no change in yield. It's referred to as roll down here. We are making the assumption that, we bought this bond with 10 years to go and that we're thinking about selling it essentially with 9.5 years to go in six months' time. We are making the assumption that the yield curve is flat between those two times, aren't we? This is just the return due to, or change in price due to roll down, and we are assuming that the yields are flat. So there's been no shift in yields. This one here assumed that yields shifted down by 0.25%, this one here, all right? But with no shift in yields and the assumption that the yield curve is flat in this small segment here, we essentially say that yields stay the same. We lose a 6 month period, so that's still 19 6 month periods. Yield has stayed the same because essentially got a flat yield curve. All right. If the yield curve had been steep there, then we would still have a roll down in yields, but we're assuming a flat yield curve here. That's the implications of the way they do this calculation in the curriculum. All right. Coupon stays the same, fixed income, remember, and par is the same as well, working $100 of par here. So when you do your compute PV, you get 104.2048. That's the price of the bond with no yield shift. And it's not a surprise, hopefully, that when yields shift down, you get, in that first calculation, when yields shift down, you get a higher price here than when yields don't shift down. So let's take those prices that we just calculated, 104.2048, that's the price just due to roll down. Compare that to the opening price. These prices are for £100 of par. So that changes for £100 of par. If we divide by £100 of par, then we've got the change in value of £1 of par. Then we can scale up by the 50 million par that we hold. Okay, so that's what's happening there. We're looking at the change in price essentially due to roll down. We calculated that on the last slide. You'll remember. Okay, the opening price is here. So the change, that's the change in value of £100 of par, because these prices are quoted in £100 of par. Divide down by £100 of par to get the change in value of £1 of par, and then scale up by the 50 million par that we actually hold. That's a negative, minus 97,500. We're rolling down towards 100 par here. This must be a bond that's generally at a premium, because as time passes and yields don't change, it's getting dragged down towards par. When we look at the bond, it's a 3% coupon bond yielding 2.5%. That is a high coupon bond that would trade at a premium, so that does make sense. Now, the actual price appreciation that we expect with the shift in yields as well, so there's no shift in, no delta y here, all right? With a delta y, the change in yields down by 25 bips. We calculated an end price of 106.3828 on the last slide. We can compare that actually to the roll down price, all right, which is the 104.2048, and we can think this is the impact of yield shifting down. Okay, so 106.3828 minus 104.2048. Once again, that's the impact for £100 of par. Divide by £100, scale up by 50 million pounds of par that we actually hold, and you'll get the impact, the sterling impact, the absolute impact of the yields changing. So the overall change in price is minus 97,500 due to just time passing and yield staying the same with a flat yield curve, and 1089,000 due to the yield curve shifting down. Note that your total gain would bolt the coupon income of 750,000 onto that as well. So this trade has worked pretty well, but largely due to yield shifting down, which we weren't playing necessarily. But that's, no, we weren't playing that. Actually, we were playing a static yield curve, which is where we would have collected that extra income of 750,000, and lost a little bit on price, but would still be up overall. Let's think about the swap then, trade B. We're looking at a 10-year sterling swap. Remember, if we're extending duration, we're going to receive fixed. It's the fixed leg that carries duration with it. So we receive in terms of the carry. Carry is what you just get paid for holding a position through time in terms of income, really. And here we've got a fixed leg income of 3%. That was given to us earlier. And we know that the floating rate for that market reference rate for the present period was 50 basis points. That was given to us earlier as well. That was, we're using this data here now. Fixed coming in of 3% and the market reference rate of 0.5% going out. This is what we're going to earn as we carry the position through time. So in terms of carry, fixed coming in minus floating going out. Don't forget these are annual rates. We're only holding our position for a 6-month period, so we divide those rates by 2, scale up by the par amount. Okay, so we're assuming the notional principal of the swap is the same as the par amount of the treasury bond, but we get an income here of 625. Okay, we do need to mark the swap to market as well in 6 months' time. Now remember that swap rates have fallen. All rates seem to be falling by 25 basis points. Swap rates have fallen by 25 basis points as well. And we can view our swap as being a receive fixed coupon bond that we've invested in. And when we pay floating, we can view that as a short position in a floating rate note. You might remember from previous levels, this is the way that we valued a bond. To value this fixed coupon bond that we're essentially long, because we're receiving its income, we are going to recognize that there is 9.5 years left, same as before. After 6 months, there's 9.5 years left. The discount rate that we're going to use is 275. Okay, so the swap rates have fallen by 25 bips. The original fair fixed swap leg was 3%. That's what we locked in originally. So if that's fallen by 25 basis points, that's where we get that 2.75 from. That swap fixed rate is the average rate you apply to cash flows over the life of the swap. All right, so we're going to take that 2.75 divided by 2 to make it semi-annual, and this is what we're going to essentially discount the swap fixed payments by, or the fixed coupon bond by. That reflects yields going down. The payment under the fixed leg of the swap remains 3%, right? That was locked in at initiation. That remains at 3%, that fixed leg. And we're working in $1 of par here. So we're working $1 of par, so future value of 1 for this bond. And the 1.5% becomes 0.015 in absolute terms. Now, when you compute PV here, you're getting the market value of $1 of the fixed side notional principal of the swap, essentially. And it's no surprise that that value has increased a little bit because swap rates have fallen. Of course, when we get to 6 months' time, we know we're getting to a coupon date. All right, so the value of the floating leg is going to reset to par. I'll re-emphasize this. At any coupon date, the FRN that we're essentially short here will reset to par because the coupon will reset to market rates, and any bond whose coupon is equal to market rates, market discount rates, will trade at par. So yes, the fixed leg's trading slightly above par. We can scale it up by the amount of par that we have to get this value. The floating rate at a coupon date will always reset to par. That's a crucial key to this little calculation. So the FRN trades at 50 mil. If you're receiving fixed, which has gone up in value slightly, and you're paying floating, which resets to par, the value of the swap overall to you is 1 0.03817 if you do that quick calculation there. Now don't forget we do collect a carry here from holding the swap position of 625,000. So that needs to be bolted onto that return from essentially changes in yield. Of course, when you bolt on the 625 and the million-ish here, you get about 1.6 million. That's very similar to the total return that we saw with the Treasury bond, which was, if you remember, that was a coupon income of 750,000 plus a total price impact of about $1 million. So they're very similar. They're not the same. They're not the same because the swap reflects the cost of gearing through paying away the floating leg, and because the starting rates of return were slightly different, so the yield change has a slightly different impact. But they are very similar, which is reassuring. So make sure you can do those calculations. They're very objective. Each step is very straightforward, but when you put it together, it can be quite challenging. Make sure you go through each step. Make sure you can do the whole calculation from start to finish. That completes Module 1 of the first reading in the second study session on yield curve strategies.